While one part of the market is evaluating the consumer spending data and the other part is already immersed in the Easter weekend, we suggest you shift your focus from the end of the first quarter of the year to the April statistics. At the beginning of the week, part of the Asian and European markets will be closed again. Take this into account when forming your trading strategies. However, the macroeconomic calendar will be full of interesting releases. The most important reports that can change the sentiment towards the underlying assets are discussed below. You are watching the Traders Calendar. Much of the early part of the week will reveal the sentiment of various segments of the global economy, and Japan will lead the parade. This is where the major manufacturing sentiment data will be released. With the Japanese currency falling to its lowest level since 1990 and the prospects of a currency intervention, the yen could use some good news. Business optimism among Japanese manufacturers may have declined slightly in the first quarter due to some disruptions in auto production. The sentiment index for large manufacturers is expected to have fallen to +10 in March from +12 in December. On the other hand, the confidence index of large non-manufacturing firms is likely to have risen to +33 from +30. According to the survey, large firms' investment plans are expected to grow 9.2% in the next fiscal year starting in April, down from the 13.5% growth forecast for the current fiscal year in the December survey. With the market almost certain that the Bank of Japan will proceed cautiously amid concerns that further increases in the borrowings cost could damage the fragile economic recovery, stronger data could support the Japanese currency, while weaker data could worsen the yen's position. In Asian trading, it's also worth paying attention to China's manufacturing activity index. The yuan has depreciated about 2% against the dollar this year, but the Japanese yen and the currencies of other neighbors, South Korea, Thailand and Taiwan, have depreciated more. Although China's exports appear to have perked up earlier this year, the manufacturing sector is struggling, and weak export orders suggest that the sector needs more support. A new business activity index may give a clue as to how the second economy is faring. Chinese authorities are continuing on the services sector to offset stagnation in the manufacturing sector, which is struggling to survive amid weak global demand. The manufacturing activity index rose to 50.9 from 50.8 in February, beating market expectations of 50.6. And this was the fourth consecutive month of growth in manufacturing activity, in contrast to official data that showed a prolonged decline. The situation is expected to remain unchanged in March. Stronger data could have a positive impact not only on the offshore yuan, but also on the other Asian currencies. The day will be rounded out by the index of business activity in the U.S. manufacturing sector. U.S. manufacturing output continued to decline in February, with the factory employment falling to a 7-month low amid layoffs. The ISM said its index of manufacturing activity fell to 47.8 last month from 49.1 in January. It was the 16th consecutive month that the PMI remained below 50 points, indicating a contraction in the manufacturing sector. This is the longest decline since August 2000. March's data is expected to show that the index will finally break out of its slump and rise to 50 points. If the forecast comes true, the greenback will be supported, while weaker dollar may put pressure on the US dollar index. On Tuesday, the macroeconomic calendar will begin with the U.S. employment data, kicking off the week-long marathon with the JOLTS employment report. According to the Bureau of Labor Statistics, job openings, a measure of labor demand, fell by 26,000 to 8.863 million in January. The decline in layoffs also bodes well for a slowdown in wage inflation and overall price pressures in the economy. A gradual rather than abrupt softening in the labor market will likely cause the Fed to wait a bit longer before beginning to cut rates. Therefore, the market remains quite sensitive to the data. A stable indicator will not have a strong impact on the US dollar index given the subsequent reports, but a sharp change in either direction could increase US dollar's volatility and send it higher or lower in the short term. Already in the midst of the trading week, markets' attention will be focused on the Eurozone and CPI, and many ECB policymakers have expressed support for the first cut in borrowing costs from the current record high, most likely in June, with a debate now focusing on how many more cuts will follow. Christine Lagarde said decisions should remain data-dependent and be made at each meeting, reacting to new information as it becomes available. Money markets are pricing in 3 cuts by December, with some likelihood of a 4th cut that would reduce the 4% rate the ECB pays on the bank deposits to 3.25 or 3%. Eurozone inflation fell to 2.6% last month, but Lagarde said that conditions necessary for the ECB to start cutting rates is a slowing wage growth, a continued decline in inflation, and a new domestic forecast confirming that price growth is returning to the 2% target. If new data is in line with the ECB's downward trajectory and forecasts, the euro will come under renewed pressure from rate cut expectations. On the other hand, stronger data could help the single European currency to strengthen. On Wednesday, the market will evaluate the data on the change in the number of jobs in the US private sector. In February, the number rose a bit less than expected and amounted to only 140,000, while the wages of workers who remained in their jobs grew at the slowest pace in 2.5 years. If the ADP private sector payrolls data paves the way for the Fed to cut interest rates again, the US dollar could come under pressure. However, bearing a sharp change in the index, the US dollar index will face another test on Wednesday: sentiment in the US services sector. The ISM said its non-manufacturing PMI dropped to 52.6 last month from a 53.4 in January. A reading above 50 indicates growth in the services sector, which accounts for more than 2/3 of the economy. The PMI index is consistent with the continued economic growth despite the Federal Reserve's interest rate hikes. 14 service industries reported growth last month, despite the weakness in employment. Comments from service sector companies in the Institute for Supply Management survey were generally upbeat. There were also no signs of a rise in inflation after a jump in prices early in the year. Economists expect the index to rise slightly to 52.7 with the new data. Strong data without inflation trends to be negative for the greenback, but if the survey shows signs of a rise in inflation, the index could strengthen. This was a brief overview of the most important economic events from InstaForex analysts. Follow us and make hefty profits from your trades, so see you online soon!